The Bulls versus the Bears. Get in the game. www.tackletrading.com.
Hello everybody, this is Coach D with TackleTrading.com, here to give you a quick market update and recap. Just a real quick reminder of the disclaimer. We are here, I'm going to be working out of a simulated virtual trading account. Just in general, this is a game for grown-ups. Just remember, trading and investing has risk. It is our job to educate, and it's your job to learn how to approach the markets intelligently. Let's go ahead and move on here. Looking at the market here, let's start out with a chart of the S&P index here. Let's go ahead and get in here and look at the spider, for example, and talk a little bit about where the market has moved today. Looking at the spider, you can see where the market has broken down. We're actually looking at big drops in the market down into known support zones. Let's look at the futures just to get a slightly better look. TF, let's go ES, Russell 2000 versus the S&P, E-mini S&P futures. So we see the market here in general down into the known support zone and trading down yesterday, big drop. Today had a little bit of life to it, but kind of recovered there towards the end. So if we take a look at it, let's go drop that down intraday, drop down into say 15 minutes. You can see how the market's movements played out. Big heavy trading down, boom, today, gave up, kind of rallied lunch, started giving it up again, came down low towards the end of the day and then closed right back up into the close. So, it's a sideways consolidation pattern. We can look at the S&P and consider that a potential double bottom. But as far as the, confirmation downward move, a couple things that I would want to consider as a trader. One, failure of downward support would be very bearish. We could certainly see, for example, here, intraday, we got nice strong downward leg here. We could look for inverted cups and handles or failure or descending triangles, anything along those lines, failure of support. The other thing I would watch out for is considering the fact that from a daily perspective, I might consider the market range down. Now when we say range down, typically what we're talking about are standard deviations in price. So if I were to go grab a little rectangle, for example, here, and measure previous drops in the market, size of the drops, we can go grab a couple of the swings. We've obviously had some bigger drops in the market, but you could look at, here's a recovery here, ballpark from bottom to top. We can kind of use those as little measuring sticks. And if we're kind of looking at it from that perspective here, we look at where the market's down. You can see where it came down. In the range down, we see some dojis, and the market tried to rally. So we can look at this next one here. This is about the same size. So I'd say those swings are those are the exact same. This little bit bigger one here, and it can go more, mind you, like it did back here earlier in August. Big drop through here, but if you look at the size of that drop, I would start to bring up the idea of what I refer to as gas tank. So gas tank is the idea of where we take a potential average yield and we look at the size of the movement down, so we can say, okay, well, if this last move here was a little bit larger deviation in price, we kind of look at that ballpark here. We've seen these are smaller ones. We consider that swing range. We could probably go back and look at the previous one here and get a similar ballpark. We kind of look at it as a tank of gas, where if I know that that's a typical deviation, if you actually look at this last one here, I'm willing to bet, I'm just eyeballing this, I might be wrong. But what I believe is, one, the one we're looking at is 61.8% larger, and it is 3 of these, back to back, 3 deviations in price. So top, boom, 2, I'm going to grab the top one and go grab it and stop it, set it on the bottom, 3, that's 3 deviations, boom, boom, boom. Now the current move is from bottom to top. We could kind of ballpark that in that neighborhood of 1.5 or 1.61 deviations, which would be Fibonacci. it's a good size run for it, and it is range down. Doesn't mean it won't go further, but if we were considering 2 deviations versus 1, what the market looks like it's done for me looking at the S&P is it came down 1 deviation, and you see green doji, hammer, doji, expecting a bit of a rally, but we got that, kiss goodbye kind of whipsaw. Then here early in this week, boom, it's dropped, so we might only see it go 1.618 deviations, which is basically in the next extended fib ratio, which would be the same as it ran back here, from bottom to top. You can get the same range, but if you got 2 deviations, we could see the market break and violate that support zone and establish new lows. That's one of the things we'd want to watch out. 2 deviations kind of get you down in that zone. So as far as being, range down, I'd consider it like a gas tank, and really, that analogy, the way I would draw that out in your minds, would be to take that and say, okay, well, look, the market certainly can go lower, but if that's the size of my entire gas tank, I only have, let's say an eighth of a tank of gas or so. So I got 1/8 of a tank of gas to make the trip. And if we're looking at the market and looking at potential short positions, this is true for any time I look at stocks or the market in itself, and kind of consider it overextended. And we could say market overextended to the downside. So if we look at the other portions of the market, let's go look at the Dow/YM. And we can see a good drop range down. Again, it's not its biggest range, but you can go in and you can say a very similar thing. You can go grab a little rectangle. And really what we'd measure is, pivot to pivot, kind of a swing range. And there's going to be various sizes. But again, pivot to pivot, that's a big range. That's a small range. You'll see it as 61.8% larger. Is very, very common for that. So kind of looking at that, boom, you could say, well, okay, the market, the Dow is gas tank down, which means it could be coming into and potentially finding support. We could see it reverse. I don't think I saw that the VIX or the trend were really crazy high. They were a little high yesterday, but not crazy high. Let's look at the NQ, and we'll see a relatively similar story here as far as range down. So point being is, yes, the market can drop further, but when you look at it from, type of swing ranges, you can look at it and kind of say, okay, well, maybe, just maybe, here's some different size swings. And, duration of the swing can vary. The length of the swing can vary, but that would be a gas tank down, a swing range down. Doesn't mean it won't go more. This could be a slightly larger range, but not much. It's pretty close, not much bigger. You might look at the size of the recovery there. We might look at previous support zones, etc., etc. But, as far as like number of days in dollars without a reversal, you're looking at multiple deviations in price. We see the small move down, market breakdown, come down, and it's got new support zones down here. So if it's going to come down and hit those support zones, it would typically be running on more than one deviation in price. And as far as, big swing ranges go, yeah, it can go more. We can certainly measure those ballparkish and kind of go with it from that perspective and kind of say, yeah, the market has the potential to run greater in price. I mean, back here it ran quite a bit more than that. It actually put 2 of those together. If you go to the low, boom, you got back-to-back ranges on that. That's a healthy size swing for the market. There it is from bottom to top. You might not be able to see that candle bottom real well, but it's bottom of there. Boom, boom. So that would be, again, size of the gas tank. And that's a pretty good size run for the market. So you might consider it coming into a zone like this. And this would be in one of the areas. Maybe it's why we might see something like a trend zone for the market coming in. Boom. Now let's take a quick look at the VIX. Dollar sign, let's see here, VIX, we don't need the dollar sign, I don't believe here. So the VIX is trading at 26.83, so options across the board are a little more expensive. And then we can go look at we got the VIX, let's look at the trend. And the trend here yesterday popped up high. Today market's relatively balanced, so nothing crazy out of balance here. We'd look for the market to reverse when we see both of those highs. So high in this case recently, we've seen the trend as high as 6-7. That's crazy high. Normally I'd look for 3 to 4 to be considered high. Yesterday it didn't even quite get to 3. So I look for that trend to hit 2 is extreme, 3 very extreme. 4 are big extremes, and then you get up towards 5 and 6s, and the probability of one-day reversals increases. So, if you want to watch more videos on that, Gino's got a couple that are pretty rock solid. Overall, looking at the market, from the bigger perspective, let's just look at the SPX and drop it out to a longer-term weekly. And again, just looking at a bigger time frame here, yes, the market has been trading down. I talked about the seasonality of the market being bearish till mid-October, seasonally speaking. We got some known support zones in here, and if we're looking at the market breaking down for another drop down, you might consider 1800 big fat number or any one of the support resistance zones back in here as key price points. I'd say the known support zone is a key price point. It's a pretty solid zone in general. If we were to drop out, grab a little bit more history here. Let's go grab the entire bull market here and look at it from that perspective. We might even say the market is trading into a trend zone. So this could be your regularly scheduled bull market into the fourth quarter. So, this is one of the things where, yep, we can see the forming head and shoulders. Yep, we could see that as a kiss goodbye. Yep, all of the above. Yep, the Feds are probably going to raise interest rates. That would be something that I don't know that necessarily scares the market. It'd be a very small raise. I don't think it really slows the economy too much. Correction potentially if people look at the earnings. I think it comes down to confidence going into that fourth quarter. So watch for a little bit more trickle down, retesting of support zones. Overall, I'm going to be shifting short-term postures, looking for some very short-term bullish, maybe building into longer-term bullish in the next week or two, depending on the signals we get from the market. And if we do get that seasonal run from about mid-October, is when we typically expect fourth quarter rallies, fourth quarter reversals. So we'll keep an eye on that. We'll be posting daily updates. We'll be giving you our weekly reports, and we'll keep you in tune with the market. This is Coach D with TackleTrading.com. This has been your market update.
Isn't it time you got off the sidelines and tackled trading? Join our online community of active traders where we make it happen every day. Stocks, options, futures, and Forex at www.tackletrading.com. Get in the game.